program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Todd from FIIG Securities. And if you have any questions about the bond market or the share market, please pick up the phone. Call us on 1300 30 34 35. And the email is yourmoney@skynews.com.au. Joining me tonight is Mark Moreland from Team Invest and Matthew Kidman, who is an ex-fund manager and author. You'd be familiar with some of his books and maybe some of his work in the Herald. How are you, gentlemen? How are things?
Good.
Good, busy. Tell me a little bit about Team Invest. What's the business there?
Basically, we have a large group of members who are retail investors, so basically people who are managing their own retirement savings, largely self-managed super funds.
Yep.
They typically have $1 million plus invested, and what we do is we help them to understand risks and likely returns they get from their investments, so they help them make better decisions.
Right. And
we use the network of members. We've got about 420 members, and they are very well connected, so basically it gives us very good insight into what's going on inside businesses.
And how long has it been going?
5 years.
You're right. Yeah. And it's sort of, is it a GFC type thing? How did it go through the GFC?
Well, we sort of started in the GFC. We've got a very good software program which is Buffett inspired. It was developed in Sydney by Professor John Price, who was the Professor for Maths Finance, double degree at New South Wales Uni.
Yep.
And he made Buffett his research study for about 15 years and developed a tool which basically filters the market on a rules-based system to kill off everything that's not any good.
Yep.
And that's been running for 12 years, and it's averaged just over 10% above the index every year.
Right, for the last 12 years.
The last 12 years, which includes Australia, Canada and the US, actually.
But is that like the classic where it's a backfill, where they say if in that point in time I was able to buy on the basis of this model, I would have made 10%? Is that what it is?
Not in this case, because he actually did it each year. So basically what he did is he started the system.
Who's this chap again?
Professor John Price.
And he's now
he's a team investment director. So we bought him out. So we bought Conscious Investor. He came in as a director of Team Invest. Okay. So he's on the team.
And how are you, Matthew? How are things for you?
I'm very well, thanks. I should be doing this, I think.
You should.
Clearly.
I've got to improve my decision making.
Yeah. Well, I think that's a problem, isn't it? It's about, we were talking about before we came online, it's the idea of trying to get enough information and not really getting swamped by it. There are so many people with the view, and if you get Buffett-like and if you can get Buffett, that's probably good, because he seems to be able to crunch through these numbers quite quickly and come to a conclusion. But
and I'm sure Warren, if we're allowed to call him that, Warren's information is probably even better than ours. Then he's got his own network that spreads far and wide.
I think his network is outstanding. If you ever look at that LinkedIn, there's stuff about Warren Buffett. I'm going off track. I can't help it. Warren is, with the guy that did Microsoft. So Bill Gates says what I learnt from Warren. It's a LinkedIn story. And the thing that's really interesting to me was Bill Gates was introduced to Warren Buffett by Bill Gates' mother. She had a dinner party. She invited her son along to meet Warren Buffett. And he went, "Oh, Mum, really? I'm IT. I'm IT. I'm running the business." And he said he was stunned by Buffett's business brain and it shaped the way he started to think about business in terms of Buffett and the idea of the moat. And he had all these unique questions at that point in time that Gates went, "Oh, you're not just an old fogey that plays a bit of bridge. You're actually somebody a bit different the way you look at businesses and created that protection." Shifting yet again, protection, Macmillan. What do you think of that whole scenario?
They just about had their moat removed.
Yeah. By the government. I mean, so would Buffett have looked at that and said, do people identify that as the issue? You're reliant on the legislation, you're relying on that. Is that what you have done as a Team Invest analyst?
Interestingly, we used to like Macmillan Shakespeare. And if you look at Macmillan Shakespeare from 15 years back, so last decade, before the GFC, I think it returned about 30% compound. So it was actually an excellent investment. It was they do salary packaging, very sticky business. So they contract the hospitals and then do all the staff's salary packaging at FBT. But the risk issue for them was always was the fact that it's based on a government exemption or a legislated or regulatory approach to saving some tax. And if you take that away, it sort of kills the whole business. It'd be like saying now, if we're going to simplify the Tax Act and make it 15% flat tax, can you imagine how many accountants would be able to work and the disruption to the market? So the business was built on the fact that the FBT had to be managed and reported.
And have you been looking into what happened to them?
I have. In my former job, we were a shareholder for many years, and they've got tremendous management. Michael Kay is a terrific manager. They made the decision some time ago to go buy a car leasing fleet, which allowed them to expand their business, because part of their salary packaging business was to do these novated leases, and that's what's come under scrutiny. So I would have thought the issue for Macmillan's, there's a political issue. The Labor Party's made policy on the run, caught everyone off guard. Let's see if they win the election. The question is, do they get that legislation in before the election? We don't know when the election is. Is Parliament going to sit again? So the next month or two, we've got to ride through that. So if we get through that and say the legislation doesn't come through, there's a change in government, Abbott leaves it alone, it's all fine. The question is, what kind of multiple then does Macmillan Shakespeare trade at? Because before, as the market got more and more confident with it, it got past these regulatory issues because they've been spooked by it in the past. If it gets up there, does it ever go back to the 20 times earnings?
Because the idea
people were paying for it, because the high growth, great return business, but relying on the government saying that's fine to do that business.
But the idea that Abbott is a politician of a different cloak doesn't make sense, because they're all looking to try and work out how to make a balanced budget, how to take.
I think if the Labor Party gets the legislation through, if there's another sitting in Parliament, and just happens that the legislation gets through, I think it's easy for the coalition, if they win government, then to say, well, yeah, it does save money, it's already through, we're not going to... I know they've talked about repealing it.
And what was the changes they were looking to offer? What was it? They were just... Well, they didn't wipe it all out, didn't they?
No, they just made it much more onerous, and that people then had to run logbooks to justify their private use and so on. So rather than it being a simple saving, it was going to reduce effectively, for the average person, say $1,000 a year less in tax savings. So it was material.
But it was a blanket rule. You could claim 80% of your use of your car.
That's right.
And 20% was for personal use. So you didn't have... Now, they're saying you've got to keep a logbook. There's ways of doing it. There's applications on your phone. It's a lot easier than it used to be. And they think that will take a fair bit away. I mean, in honesty, it's just... all it is tightening it up. But it's really clobbered that market. Underneath, as you said before, the salary packaging component of Macmillan's is a tremendous business. Great returns. Not as susceptible, I don't think, because it supports a different group. But what multiple does it trade on? Maybe people will say now it's not a 20 times business, it might be a 13 times business. That's if the coalition get in and the laws don't change. So I think that's the thing people...
It's interesting though, the funny thing was, about 5 years ago when the Henry Tax Review was on, back in Rudd's first instance, the Fin did an article saying that Henry might recommend to get rid of FBT, and if Labor then does get rid of FBT, Macmillan Shakespeare's business is shot.
It's gone.
Share price dropped by 50%.
That's right.
So we bought on that because we thought that was ludicrous, as if a Labor government or any government would get rid of fringe benefits tax. I mean, just thought it was zero,
if you consider it, the big thing is, and it's actually hit them here a bit too, but by salary packaging, you're giving a whole bunch of what would be Labor voters, but government employees of some form, or people who work for religious groups or charities, you're actually giving them a boost in their income because they can claim before they pay tax on certain issues, and the government's happy for that. I mean, that's the kind of thing. Well, why would you cut the wages of a nurse? Why would you cut the wages of a policeman or a fireman?
So you're just making them work harder.
Well,
carrying the logbooks, to your point, they're going to be carrying...
Well, this is the car component of it, not the original salary packaging. The car's an extension of that. I don't think they'll ever touch the core bit. The Catholic Church and many other churches came out strongly at that stage. But the car component, all they're doing is tightening up what was a very loose rule. And
it sort of makes sense.
It kind of makes sense. But, once you go down that path, if the rule's there, people will take advantage of it, and that's what's happened.
There's another key issue, just on it quickly, is that the Macmillan...
Be slow, we're good now.
When they bought GMAC Finance, which was with the novated leasing business, that was roughly, I think, going on memory, about twice the size of their current business. And the current business, which was the salary packaging, was high margin, low cost. They bought a finance business, which was low margin, high cost. General Motors wanted to get out of it, which is after the GFC. And when they bought that, they took on a heap of debt. Before that, they were debt-free and had the cash on their balance sheet. And they went to about 100% debt to equity, which we have about an absolute 60% max debt to equity as a rule. So we killed it on that basis. Then the trouble is now, this is a perfect example of what happens when you have too much debt. Their debt was roughly 75%, I think, before this problem happened. And when they suspended the shares from trading, I suspect it's because they may have been potentially going to think they were going to breach a covenant or something to do with the...
well, I think they also got caught on the hop.
Yep.
Yeah,
The decision was made, there was no forewarning. The stock traded 6% down like that.
Yeah.
And then they thought, oh, we better do it. We don't know what's going on here. Which is fair enough. But yeah, the business did change. They bought that business at a great price, below asset backing.
True, that's true.
But it changed the risk profile of the business.
How do you manage that debt?
Well, that, from our point of view, is just too much debt, which increased the risk too much. So,
Well, if you buy something cheap, though, it's got debt, you've just got to get rid of the debt. Use your income to pay off that
well,
debt.
They reduced it down. I think it was 120% debt to equity when they bought it, and they got it down to 75.
They're on their way.
Yeah, they were. That's true.
So
and you're right. The market's paying a very high PE. I think Matthew's right.
Yeah.
Once it comes out of this, it's very unlikely to go anywhere near what it was.
It's going to have the regulatory
risk,
risk.
and also the debt.
We're going to go to a quick break, so we'll have to leave it there. We'll be straight back. We'll have more from our guests, Mark Mullen from Team Invest and Matthew Kidman. We'll be right back. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities. Tonight I'm joined by Mark Mullen from Team Invest and Matthew Kidman, a ex-fund manager and now just a good bloke. They're here to answer your questions. If you'd like to give us a call, please give us a call on 1300 30 34 35. The email yourmoney@skynews.com.au. The equity trade, the yield trade, is that back on? Is that the?
Oh, yeah.
You know, I think the idea that Bernanke comes up and says, you know what, let's just separate the bond buying from where the interest rates are because they're staying low. Carney in the Bank of England said, first time ever, I'm going to give you some forward guidance. Interest rates are staying low. Just get on. And then Draghi, ECB says interest rates are low. First time ever, we're going to give you some guidance. Did the market respond to that and say, look, I want to buy bank yields and Telstra? Is that what's happened?
I think so.
Yep.
Yeah, absolutely.
And that's so. Why wasn't that a good deal 6 weeks ago? All due respect.
Well, I think that Bernanke rattled the sabre the first time and told everyone, well, hold on, it's not going to last forever. He tested the market, and that debate had been out there since last December. He's someone who allows the Federal Reserve to talk openly, which is interesting.
Yeah.
So he let the dissenting voices, and then he joined them, tested the market. As we all know now, there was a bit of a spook. There was the bond sold off and yields spiked, which was a good test. And he's come out now and said, just calm down. I'm very much so. That's probably why. And everyone thought, right, so the days of the US dollar weakness are over. We're getting out of the safer, what we thought was the safer currencies like Australia, and that yield. I think what happened was there's a big misrepresentation of what drove those banks and Telstra so high last year into early this year. And it was blamed on the average punter who was looking for yield. And I'm sure there was a bit of that, but really it was the overseas investor looking for yield. And I think a lot of them are gone now.
Yeah, would you agree?
Totally. And I think to me, the banks are actually quite a risky area to be an investor in at the moment because they've been ramped up so much because of the fact that the differential on the lower interest rates has been so good. It's just pushed the prices up.
Yeah.
And that, obviously, if interest rates come up, which they have to eventually, they may not be for another year or two or whenever, but when it does, it's going to put them under enormous pressure from a capital point of view.
Yeah.
A lot of investors don't think about that. They think of the yield. Like, don't worry about the share price because look what I'm getting. I'm getting 8% yield or something. And of course, if you have a 5% drop in share price, your actual total return is 3%.
And I also think it's a limited trade. Like, interesting with the Australian market, it's traded between probably around 4,000, sometimes it dips under, up to 5,200, I think it got to in the last. We've just stuck our head back over 5,000. You can't keep buying Telstra and the banks to so high just for yield. At some stage, there's got to be some growth in their earnings. So I think we're at the top end of that. So,
and they're all under pressure. The Telstra and the banks are all under pressure as far as growing their earnings.
That's right. Yeah.
Telstra hasn't grown its earnings for 10 years.
No,
so
that's right.
I mean, a lot of people say with Telstra, if Telstra can maintain its earnings and maintain its dividend, then that's okay.
We've got a caller. We've got Ryan from New South Wales calling, but I need to talk about Telstra after this call.
Yeah.
Ryan, how can we help you?
A question on Origin notes. I've purchased a few of them, and I'm just wondering whether I'm happy with the return I'm getting, but why they're trading probably below the $100 value I've purchased them for.
Origin notes. Are you familiar with the hybrid market?
No.
So Origin notes. What happened with Origin was that there was a a ratings agency came out and said that they won't be able to take this as they have to take this as equity if they didn't call it. Origin said, well, our intention will always be to call these notes, and so markets don't believe what corporations say, so that's why they'll be trading under par. But essentially, if you're happy with the return, Origin, it's a nice solid company, you've got a nice hybrid bond, you'd have to look at your entire portfolio to see how it's all played out. But essentially, if you're liking the return, if you're looking to trade Origin notes, hybrids are not something you'd look to trade. Hybrids are things that will give you a consistent dividend, and subject to having the right company and knowing what your risks are in terms of conversion. Origin seems to be a reasonable hybrid to be able to hold. A lot of the corporates are quite good hybrids to hold. I like some of the issuers. I don't so much like Crown, but some of the issuers that come out in hybrids are quite good. And it's a cheap form of funding for the organisation. I think a lot of the bank hybrids are great. The pearls and all that sort of stuff. I'm not sure,
otherwise they wouldn't keep doing them. They keep doing them.
It's great. They do them, and it's great for...
And they do it at lower than their yield at times.
That's right.
Like the ordinary share yield.
You could go and borrow money from them, and it's quite strange how they do that. But I think, when we had Steve Lambert on last week, and he was saying it's very expensive. You send $1 billion of these notes out, you have so many investors you've got to update, constantly updating all these people about the coupon payment. Huge admin cost, and that's why your return is where it is. Because of the embedded cost, and also, landing on the ASX is quite expensive to do any issuance in the United States. In the ASX, United States. The miners and all the miner supplements, they seem to have been absolutely belted. What's happened there?
Well, with the miners.
Yeah, the miners and all the Ausdrills, the Boat Longy, all those sort of things have been absolutely...
Team investors never like the miners.
No miners?
No. And the reason is simple. Their price takers, they can't control the prices. When they're going strongly, that's fine. We've invested much more in the mining services area for the last year since we started, which has been really good. Admittedly, lately there's been some issues, of course, because your Monadelphous and a few of those were on PEs of 25 times earnings and so on. They've come right off, which was pretty inevitable, which we discussed, and a lot of our members sold out last year because of that. But I think the miners, it's obviously to do with China's supply. We're generalising, talking about the whole lot of them, because they're all in different areas. But I think it's probably to do with confidence or fear of what slowdown in China would do to them. Plus the commodity prices have come off, and iron's back up, but coal's been right down. So,
are you worried about the China effect on those miners or the miner supply business? China seems pretty hard to come to grips with at the moment.
Well, China's got this the great rebalancing. 3 years ago, everyone was very negative on the US. The US is a fallen giant. China's going to never come back. China's never going to... the US is falling away. China's going to be the saviour. The economy's going to be the biggest one in the world. We're in the right area of the world, all this stuff. 3 years on, the US, geez, what a recovery, great. And China's now... You can't find someone who likes China. I think that's what's created a little bit of a bounce in resources stock. We got so negative about China. But what do I think about China? I think it's a terrible economy. It's this rebalancing. It's overbuilt. We know everything now that Jim Chanos was saying 5 years ago, and he rode that out with his shorts, is actually coming to fruition. They have no idea how to control it. Yep. It's so obvious because they go from month to month, and everyone hangs on every announcement. But can they get to a consumption-based economy like all the others? I don't know how they're going to do that in a hurry. It's very hard. What I do know is that mining booms go for between 12 and 18 years. This one was a very short one.
Yep.
If it's over, it could change. They could turn on the taps again in China and off they go again. I don't know. But the busts or the downside, the bear markets last 20 years. So I've got no upside in miners. I'm not a big investor. The mining services companies, some of them will go broke. Some will survive and get more business, but that's a terrible business because you've got such a concentration of customers and you require so much capital, and when they turn it off, all that capital just sits there with no return.
And they don't care. And it's interesting how I think the miners have taken on this cost-conscious basis, when previously they'd have no cost consciousness at all. No. And I'm BHP, I'm going to buy you, Rio, and if I get it wrong, here's $700 million. Yeah. Extraordinary behaviour. And yet now they say we're going to cut costs. Do you believe it? Is it something you think they can do?
Well, they have to. It's interesting. One of our members...
But hang on, Mark, before you answer that, it's thousands and thousands of staff who didn't worry about a paperclip, who didn't worry about saving any money. So now you've got to change the behaviour of 30,000 people. If that was easy, Parramatta would be at the top of the table. So it's hard to
That sounds a lot harder. That sounds a lot harder.
Just come out of Parramatta.
Start stretching it.
Yeah, that's right. That's
No,
right.
I think it's already happened, Mark. It's already happened. Two big miners, they've had change in managers. The culture's changed. They brought in for these guys are the down cycle, down market guys who are going to penny pinch to a degree. They're going to come back to normal. Even Fortescue has told everyone now our costs are down. It's happened.
You know what? I actually agree with you, and the reason why is because of Marius Kloppers. And I'll explain why, because we have to go to a short break. But I'll be
Is he joining us?
1330 34 35. Mario is very busy. You can email us at yourmoneyskynews.com.au. We'll be right back. I'm Mark Todd. Joining me tonight is Mark Moreland from Team Invest and Matthew Kidman. They're here to answer any of your questions. Please call us at 1300 30 34 35. The email is yourmoney@skynews.com.au, and we have another caller. It is Jack from Victoria. Hello, Jack. You wanted to ask a question about Macmillan Shakespeare.
Thank you guys for taking my call. I know that you have discussed this Macmillan Shakespeare at some length. I'd just like to ask Mark from Team Invest, does he consider that it is still of investment grade? And also, what will be his valuation in the worst case scenario if the legislation is passed, please?
I can't answer that, quite frankly, because it failed our process when they bought GMAC, so we haven't actually been following it since then. So I've been looking at it with interest the last few days. But when I had a look at it, because the debt's still so high, and as a relationship to equity, it'll be even higher on the lower share price. It doesn't meet our criteria, so it's very hard to put a valuation on it. Particularly if you say if the legislation passes, then what's it going to be worth? Well, we'd have to get a handle on how much of the business are they going to lose. And I think it's been a bit hysterical at the moment. Where there's everyone saying, "Oh, immediately all these cars have been cancelled and so on." I think it's probably being exaggerated, but there is definitely going to be a cost, and I have no idea what it is. So if you bought it now, from my point of view, it'd be quite speculative.
What do you think, Matthew?
So the scenario is legislation goes through. The company said it would affect about 40% of their revenues, but it's a higher margin part of their revenues. So company 100 million of revenues, 60 million of profit, something like that before this. 40% of their revenues, so you're talking about 40 million. Maybe they lose half to 3/4 of that, or maybe it could be all of it, I'm not sure. But so you're looking at a company all of a sudden that could earn somewhere between 20 and 40 million instead of 60. So it is, and with that, it's material if the legislation goes through. And then you're going to have to put it on a multiple. So it reached 1.3 billion market cap at the peak. So if you're talking worst case scenario, something that's 25 million and you put it on a PE of 12, say, you can do the maths, you go back to about 300 or somewhere around there.
Which is a third of what it is now.
A third. That would be the worst case scenario. I'm not saying that's right, but if Jack wants to hear what it could go to, that could be it.
And I suppose that to your point, the final point was the right point. It's now speculative. You're now punting on the exchange, politicians, of both sides. So
because it's an election year, though, because we're in election, the unintended consequences of this are much more material, I'm sure, than Rudd and team thought. Because if the car companies, everyone's jumping up and down. If it affects everyone badly, the government will end up having to pay out more to the car companies in compensation and so on than they're going to save on the FBT changes. If that happens, you'd have to think they'd kill it before the election. So I think if I was going to bet, I'll bet it won't happen.
Yeah, I agree. I reckon there's 60 to 70% chance there'll be no legislation passed and the business stays intact, but it will have a multiple de-rating because of the scare it's had. So instead of 20 times, it might be 13 times, but on that full amount of earnings.
And you're right about the point that car industry has so much sway over government behaviour. It's extremely interesting how they say, look, in Adelaide we need to have these car companies, we need to do all this, Geelong, so on and so forth. And it's interesting whether you think that's a relevant business that we should be in as a country, but certainly the government's
I think the current Prime Minister misread the tea leaves a bit in terms of who it will impact. Not only the companies, but who gets the benefit of that. And it's not
much deeper than he realised.
It's not fat cats, it's a whole bunch of people who over the years have been exposed to salary packaging, and it's probably some of their core voters. So that'll be interesting.
I was going to move on to the United States, and I was thinking, how do you think, what's your thoughts on a rate cut? I mean, but leading into the United States, we've got all this talk about interest rates going lower. Is there going to be a cut in August? What's Team investing about interest rate cuts.
We don't actually get into forecasting them because I think it's a bit of a fool's game. It doesn't really affect our decisions that much. I mean, from a personal point of view, if you're going to ask me to bet on it, I think it's likely to go lower. We're following, basically what's happening with Bernanke's calling the tune, and we're reacting to it. I mean, the Reserve Bank here probably wants them to be lower. I mean, it's going to create a bit of inflation though as they go down. It's going to help the miners, it's going to help manufacturers, but it's going to all the imported goods and the consumer products are all going to go up, which is going to be inflationary. Fuel's going to go up and so on. So I don't know. What do you think?
Do you look at interest rates?
Yeah, look at interest rates all the time. I think we will get 2 more cuts. I think the construction downturn from the mining sector, they got a bit of a shock how fast it turned down early. And if you remember, the Reserve Bank forecasts were a peak in 14 or a peak in 15, and slowly it came back, and now we know it's peaked. So the construction side of it's going to come down, which is a big part of GDP. They'll have to stimulate that. Even though the housing market's picking up gradually, it needs to take up the slack a lot more. They'll cut rates, and I think the dollar has come to 90 cents, and I'm sure there's a bit of inflation in that, but the Reserve Bank would like to see a lower dollar, but it's stabilised for the last 3 or 4 weeks around this 90 to 92, and I would think they'd like to see it in the low 80s, and so they might encourage that with another rate cut, whether it's August, September, and I do think the election does not matter. I think Glenn Stevens is very independent. He likes that idea. If they call an election, it'd be just as likely that he'd say, right, we're going to cut rates. Bang.
And for 2 cuts, are you now looking at what, 2 1/4?
No, I think 2.5's almost a certainty. 2 1/4 maybe by Christmas, but I wouldn't bank that yet. But I think they'll get to the point where they say, well, inflation's 2.5%, interest rates 2.5%. If we cut them any further, it mightn't have the impact. I think we're getting close to the bottom, unless something dramatic happens.
Yeah, I think it's interesting that the $64 question is how much of that gets passed on. The banks are reaping the real benefit if you go that much lower, and I don't know how stimulatory it is because I sort of feel that the consumer continues to get more cautious, and I think in this environment right now, anecdotally, it feels like the economies are pretty weak.
But there's the other part of it too is that everyone tends to forget about is the fact that the retirees and all the people who are relying on fixed interest to pay their retirement living costs are being slammed. So it's all very well for the young first home buyers and so on, but there's an enormous percentage of people who own their homes freehold and relying on the interest rates they're getting on their deposits, which is forcing them into equities and taking risk, which we said before about the banks and the yield. So it's encouraging much more risk for people to try and maintain their incomes.
I mean, clearly the term deposit market is much lower than they had been had been used to, if you like, and you see that home ownership has gone through the roof in terms of debt reduction is constant, and it's just the idea that people will go out and now buy flat TV screens. I can't actually see that happening, and I imagine. I just imagine that I agree with you. I think the lower currency is going to come about. I just don't know how it'll affect those retailers and that inflation piece coming through. And if it starts to affect those guys, it's very hard for that equity market to rally around that piece, around that retailer piece. But it certainly seems to me that the property...
I think you're right, Mark. I think unless we see an uptick in that sentiment towards, I want to own a house and I want to fit it out with a whole bunch of goods, because the home is the lead for retailers. By next year, interest rates have been low enough, then I think there's a bit of a change that's happened. I think it'll come through, but today it's not. Retail is tough.
Incredible.
And it's not getting better. I think April was probably one of the worst months. May and June a little better, but it's patchy and it's tough. And I think that if it doesn't happen by, say, this time next year with these low rates, we're in a slightly different environment, and the bears who said, look, we've overgeared, we've got 10 years, 15 years of rebuilding our balance sheets, might have a very strong case.
I couldn't agree more. And I think it's very hard to see the consumer change in his behaviour. And, what do retailers do? Because it used to be, it's the internet. I don't think it's the internet anymore. I think it's just people just don't want to buy stuff.
Yeah, I think overall spend's not going.
We have to go to another short break, but please feel free to give us a call on 1300 30 34 35 for any questions on investing. The email is yourmoney@skynews.com.au, and we'll be right back. Welcome back to the show. If you have any questions about the bond or equity market, please feel free to pick up the phone, 1300 30 34 35, and email yourmoney@skynews.com.au. Now we'll go to our first email. This is from Justin in Kellyville, who writes, I've been buying fixed rate bonds. Should I start buying floating rate bonds? I'll offer the answer because you two
You're
are
the bond
bonds.
expert.
just got another email from somebody about, people are saying that you should buy short-dated interest rates. I think you buy interest rates that mature in 2016, 17, 18 because I think you need to get out of the problem of the interest rate cycle at the moment. Everyone is saying we have a low interest rate cycle. I guess that's to 2015, 2016. So if you buy a fixed rate return at 2018, by 2015 you now have a 3-year bond, 2-year bond. You come down that curve, and that's rather than having reinvestment risk. So that's the first thing I think. And the second is I think floating rate notes, unless they offer you 3.5% over the cash rate, why would you? I wouldn't want to buy it.
Is a floating rate the same as an inflation indexed one, or is that
no? Inflation's one that, with inflation rate goes up, your capital expands. I tried to talk about this last week on the show, where we're trying to do sort of bond 101, which is the capital is here, it expands with inflation. That's a good thing. The return is fixed. That's good. Well, that's all part of somebody's portfolio. And floating rates are hybrid. Right. So cash rates going up or down. If cash rates go down and you've got 2% over the cash rate, therein lies your problem. It's not enough spread. So things that are 3.5%, 4% over the cash rate, go for it. It's not a credit.
But if you go for longer term bonds now, while they're still at historically low rates, if the interest rates go up, doesn't the value of the bond go down?
But what's the interest rate on those bonds that at the moment, because of Bernanke and the joy that he delivered, you're getting Downer at 6%. You're getting Qantas at 6%. That's your. I'm not saying buy 5% returns. I'm saying, well, hang on. If you can get a 6% fixed return, we think cash rates are 2.5%, 2.25%, 2 something, and you'll be double the cash rate for. And when does cash rates go up? Yep. So if you look at that part of your portfolio, and it's 2 and a bit over cash for the next 2 to 3 years, I guess. Cash rates aren't really going to go up. That's probably for a portion of your portfolio. Good. Go on. Buy Macmillan Shakespeare and have a crack at something for 10 cents in the dollar, whatever.
Is the yield curve too steep, Mark? Because the 10-year and the 3-year all spiked in terms of yield.
That's right.
When the US did, which is unusual because our economy seems to be getting worse, not better anyway.
That's right. So I think that's where corporate bonds become. I think you've got to segment around what's the government bond curve. Just leave it alone. It's got a 3 on it. It's not worthwhile. You're not going to trade that. Whereas if you're looking at corporate debt, because that government bond curve has gone up, that corporate debt becomes quite attractive because of good quality corporates. So go and take advantage of that interest rate movement to buy those, because I think that long end on the curve will be bought over time. I mean, I just feel that we go to 2.5, the inflation's at 2.5 and you get 4% bonds, you'll probably buy those. We have another call. It's from David from Sydney, and he wants to talk about interest rates. How can we help you, David?
Oh, hi, Mark. And the other 2 M's as well, as it happens.
Triple M.
Look, Triple M. That's exactly what I said to your telephonist. What I was just interested in was the team's view on when we would start to see interest rates rise. I know you mentioned it briefly as I've been watching, but I'd be very interested in your opinion, because that will obviously affect how long one might put money in a term deposit at a rate.
Sure.
We're talking about Australia?
Well, David, I think the answer is around the fact that we can't talk about Australia. In other words, they're all interconnected. If Australia is at the wrong interest rate, it affects our bond curve and affects our currency. So our interest rates are in. I think when Stevens makes a decision on interest rates, he looks at where the US is. There's an anchor at 0, or whatever the rate was. Europe is at 0. Japan is at 0 or -0. And so he makes a price around that. I think European and the British and...
I think unless we get an inflation spike, which could come from the currency if it fell to, quickly. Or could go through the roof. I don't know what the spike would be. I don't think it's going to come from the labour market, because I think it's getting softer. I think the earliest Glenn Stevens and his team would turn rates upwards is late 2015.
I couldn't agree more. I had 2016 ahead.
Yeah, I think it's down because the economy's not responding yet.
No way.
In any meaningful way.
And they're lag numbers. I will cut my rates, and I need you to give me 6 months, 9 months of performance before I start to lift my rates up. I'm more concerned about the performance as opposed to the absolute rate. I want to know the reaction. We're late 2015 on 2016.
That sounds plausible, because I think at the moment the pressure's down. Because we still have a premium. In Australia, we still have we're a good place to be, apart from the exchange risk. On the dollar going down against the US, we still have a premium. So there's a carry trade there still, even though it's fading. I think we are going to continue down for a while, and then after that, really, I think it depends on what happens in the US and the other markets. That's really going to dictate what happens.
Well, let's talk about the US. if we talk about the tapering, the Bernanke came through. That spook that he was talking about was that in September I might look to cut back my buying. Instead of buying 85 billion, I'll buy 65, or I'll buy less. Markets got very volatile. I'm assuming that if we have another rate cut, we won't do it because in that August, September, because we want to see what Bernanke does. Otherwise, that volatility, that negative, it'll affect the consumer. Have you been looking at Bernanke? What's your thoughts? Can we talk about that and Warren Buffett? You know, have the double for you?
Yeah, well, I went to Buffett's AGM in May, and then went to a couple of hedge fund conferences and so on over there as well, which were good fun. And the mood generally in the US is very, very positive.
Yep.
So, in fact, Buffett, one of the hedge fund guys I was talking to, said he's been to Buffett's AGM for the last 16 years straight, and he was the most positive this year that he's ever heard him,
right.
Which is interesting. His companies are doing very well. I mean, I think a lot of anecdotal evidence in the US is that a lot of businesses are doing well because of the cheap energy. There's also a lot of manufacturers are moving states, so they're getting rid of a lot of their pension liabilities and so on by closing up shop and then taking a deal to move to another state and getting special deals. There's a lot of movement going on.
They get one in Detroit.
Yeah, that's right. Good deals in Detroit. So there's a lot of positives over there on that. I think energy is probably the single biggest one, and the US still has a very flexible, low-cost labour market.
Did that make sense to you, that Buffett's confidence? Did it feel like the economy?
Well, it was interesting. He went through some of his companies, like he bought into Burlington National Railways about 3 years ago, I think.
Yeah,
and of course,
it's $8 billion.
And he's spending $5 billion a year just improving the infrastructure. And he said he can work 30 years out what their revenue is going to be, and it's fantastic. And they're starting to cut oil, coal, all sorts of stuff, which they weren't doing before. So it's on a solid expansion.
We're going to go to a break, but doesn't that seem strange that Buffett steps in and all of a sudden a very old enterprise is now doing something new, like I will cut oil? I mean, who was running the show before?
Yeah,
I think a couple of things, Mark. I think, not to badmouth Buffett, but I think he probably was the biggest winner out of anyone from the government bailouts in the GFC. Yep. He could have went under.
He said that, by the way.
Yeah, he has. Yeah,
he said that. I mean, he's an absolute beneficiary of it.
And I think he's now one of the biggest beneficiaries where the corporate America has screwed the living daylight. They've found cheap energy, but they've screwed the living daylights out of their workforce, and you can see it in their margins. Until that changes and you get top line growth, I can see why he's bullish, because the capitalist is just such a winner out of what's happened. So I don't think it's sustainable, though. I think he's living in a dream.
Let's talk about that after the break, because I couldn't agree more. I think that dream will come back from those people who've been screwed down. They'll come back. There'll be that sort of wages revolution. We'll go to a very quick break. We'll be right back with more insight and analysis coming up next. Welcome back to the bonds. Welcome back to the bonds and equities edition of Your Money, Your Call. We're still taking your calls. The phone lines are open, 1300 30 34 35, and the email yourmoney@skynews.com.au. Let's talk about what we were saying before the break in terms of I talk to people. I used to work in the States. I talk to these guys who are either employers and employees, and I haven't seen the divide greater. Yep. The employees are being told, you're hopeless, you're lucky you got a job, there are people out in the street ready to take your job, work harder, expect less, so on and so forth. Obama's an idiot, you're going to get free healthcare. I just feel that there is a groundswell of support for the revolution. It feels very French the way they're talking. But
really?
What's your interpretation? Do you see a wages spike?
Yeah, I didn't see that. I mean, there has to be pressure eventually, but unemployment's still high. They want to get down to 7, remember, isn't it 7 the figure now? 7.5. Yeah, it's still quite high, so that's going to keep a bit of a lid while there's plenty of workforce. A lot of it's unskilled though, so you're generalising when you're talking about it being low. I mean, their bottom line, people who pour coffees and open doors and stuff like that, obviously they're on the $10 an hour or less.
I'm talking to guys. The guys I'm talking to are actuaries.
Yeah, they're not paid well. They're not paid well.
No, they haven't had a pay rise. The people I actually talked to a team of actuaries that I used to work with. That was an interesting bunch, let me tell you, that hadn't had a pay increase since 2007. And they said what happened was traditionally we would have got an annual pickup, would have been whatever, 1%, would have been something on a regular basis. And they said, not since 2007. We just had this Skype call just to catch up with these guys. And they were bitter people.
Were they?
They were furious.
Because that's the one thing that surprised me, the masses haven't arced up. I mean, we saw, what was the thing? Occupy Wall Street.
Yeah.
But that died and it was bad-mouthed and it's ridiculous. It's strange, but you would think, look, there's an upside. wages growth comes back, consumption picks up, we get top-line growth, the corporates might shrink on their margin, but they still get profits. The corporates always win. No matter what happens, they will win. That's the way the American system is. But there might be a period where there needs to be a catch-up, and that could see interest rates spike and multiples contract. I think that's the danger period for the US. It's for Bernanke. But at the moment, the corporates have just... It's been terrific. There's no top-line growth.
Yeah.
And they keep printing better. I mean, there are some sectors, there's some terrific companies, but...
We have another call. We have Jeff from Melbourne, and Jeff wants to talk about Preco, I think.
So,
I'll tell you about that. Hello, Jeff. How are you?
Good, thanks, Matthew. Good. There's a fixed interest bond called Preco, Praeco.
Yeah.
It returns a fixed interest of 7.13%, which is really good at the moment. I'm just interested to know, as interest rates go down, and they have been going down, if they continue to go down, is the face value of that bond likely to increase substantially? And what would happen to the face value if interest rates started to rise?
The correlation is like this. If interest rates go down, the value of that 7.1% becomes more attractive to other people, and so the investors will pay more. So the value, the price they pay, will go up. So if it was $100, it becomes 101, 102. As interest rates go down, that 7.1 is a better return compared to what everyone else can get. The opposite applies. If interest rates go up, that 7.1 becomes less attractive, and so the value of the bond decreases over that period of time. Preco is the Defence Housing Building, so it's a public-private partnership. Mm-hmm. So it's 30 acres over in Canberra. It's it's never going to be a backpackers. It's one of those things that the government do around how they build their infrastructure. They had Leighton's. It's 80% owned by IFM, Industry Funds Management. Mm-hmm. So that's a $45 billion. They own 80%. I think Leighton's owns the other 20% of the equity. It is in a operational phase. So what happens is it's built, it's handed back to the government rents it, and Spotless have to clean it. And anything that needed to be repaired, Leighton's have to come back and repair it, and there's some arbitration if they dispute that the wall cracked or whatever it might be. And that bond is trading at over 7% because Moody's were unsure of how it will refinance itself in, I think it's 2020. So it's the same as Macmillan Shakespeare. People go for, whoops, Moody's has said they're unsure of something and they want to sell it. And so it becomes a 7% bond that some people say that's a reasonable risk for the return I'm going to get. It matures in 2020, so they think that's a pretty reasonable return, which hindsight will prove them right or wrong. Now, we were talking about the US. I guess one of the things that seems obvious to me is that everyone is talking to us about a corporate bond market. We need a corporate bond market, and I guess that's just part of the education.
There is one.
Do you think, other than at FIIG, do you think that we need a corporate bond market to your investors? How many investors do you have?
Just under 500.
And 500 investors are basically only buying equities, or do they buy hybrids?
Well, they may do other things, but with us, we just do equities.
Yeah.
So they might have real estate and do other stuff. We don't do that though. So we're focusing on the equity component of their investing.
Yeah.
And some of them buy the hybrids, but generally speaking, because they're engaged investors making their own decisions, they tend to be quite comfortable with risk and total returns on shares. So there's a bias that way rather than a fixed interest. But I'm sure some of them have hybrids.
Your thoughts on the corporate bond market?
Yeah, I think so. I think it should expand.
You want more competition, do you?
Yeah, absolutely. I mean, if you have an Italian restaurant, you go to Leichhardt. You open it up because they'll go there for Italian restaurants, and they'll say, let's do that. I mean, it seems to me that it's the Keating, it's the Murrays, it's the Henrys, it's all the people that are opinion makers, and then it's regulators saying, you are going to have it whether you like it or not. So it seems to me that there'll be a corporate bond market. I just don't know how it's going to evolve. Does it have to be an ASX listed? But the ability, if you talk to any of the banks, their greatest problem, and it'll be relevant right now, is going to the United States. If the United States doesn't want that Westpac or NAB, and admittedly NAB did $1 billion at 75 basis points, but ultimately they have that risk around there's a better deal elsewhere. And if we've got, what's the mortgage rate now? 4.5%? At what rate would they say United States interest rates have gone higher from the bond market to what we were just talking about, and you try and bring it back here in Australia and say, look, I'll be able to fund my mortgage book? That's where the greatest pressure on the banks are at the moment. that cost of funds and trying to articulate.
But I think a corporate bond market probably only happens when the US option dissipates.
That's what I think.
But I think it'd be a great thing because the superannuation money that the projections are, now projections can be wrong, they tend to be, but probably the trend's right, that we're going to have a huge pile.
Huge. Future funds, 100 billion.
The way the tax system's structured now, all they're going to do is chase frank dividends.
Yeah. It's time for a short break. We'll be right back in a moment with more from Mark Morland from Team Invest and Matthew Kidman. Welcome back to the last segment for tonight. My guests are Mark Morland and Matthew Kidman, and we have Ray who would like to talk to us about the NAB, and he's from New South Wales. Ray, how can we help you?
Good evening, gentlemen. Mate, I've just been given some advice on the NAB with the purchases they made of the bank that wasn't really a bank in the UK. They've written the values and that down, and it's now probably worth more than what they've written it down to. They're probably going to return that to profit and start giving some more dividends and bring them back to more like the returns of the Westpac and ANZ. I'm just wondering, for the next few months, is that going to be the case, or what's your outlook?
What's your thoughts on NAB? And I think Ray's basically saying, does NAB start performing like CBA, Westpac, or does NAB continue to be the laggard?
Well, the Team Invest approach is we put a lot of emphasis on past performance, and past performance is the best indicator of future performance. Not a guarantee, but it's definitely the best indicator. And if you look at CBA, Westpac and ANZ, for the last 10 years, they're all within 0.2 at about 10.2, 10.4% per year return. NAB is 3.5. So NAB has underperformed its peers by 2/3. So it's been a disaster. And the reason is that there's been overseas expansion. They did Homesite in the US, which was a disaster.
That was a complete disaster.
Yeah, total disaster. They came back, they did it again. They bought it in the UK at the top of the market. And that hasn't been fixed. You know, the UK, even though they've taken it right down, it's like a festering sore. You know, so from my point of view, I wouldn't touch NAB because I wouldn't trust the management. Even though it's changed, culturally they have got they're serial underperformers. So of the banks, NAB is the one we wouldn't touch. Perhaps now that they'll get it together and they'll be okay, maybe.
You know, some of the guys in NAB there are pretty good operators. I think it's a question of it's such a big organisation, you have to change a lot of culture.
It's interesting that culturally though, these businesses that make big mistakes tend to repeat them. It's quite interesting. Whereas the companies that are really well run tend to stay well run. It's just an observation I've made over the years.
What do you think?
I think the NAB with the UK, they might have written it down, but there's liabilities attached to it and they can't get rid of it.
They just can't, no one will buy it.
So I don't think that goes away. Can they quarantine it? That's the question. NAB, the greater NAB, got cultural problems. They're not as well run as the other banks, but I would tend to, I'm not saying they're unfixable, but I wouldn't be so enamoured in the other banks. I think through the GFC, a lot of things were smoothed over, NAB being one of them.
Yep.
I think CBA had problems that no one talked about. That St George disappeared. Why did it disappear? Westpac picked it up. They were unusual times, but don't think these banks don't have their problems. But it makes no sense for anyone in the broader community to be spooked by it. So I generally agree with Mark that NAB, but at the moment they're by far the worst culture. They just haven't got it together. Decision making's poor, allocation of capital is poor. Some good people in it, there's no doubt. Big bank,
absolutely.
It's fine, but it's just the others have got a better process and a better culture and a better allocation of capital.
It's interesting the effect of, and we're going to go for the end of the show, but it's interesting about Narev how he's affected that CBA at the top. When you talk to anyone at CBA, they are completely on song. They really do follow what his leadership is offering. I'm not saying that
single voice at the.
I'm not saying that Cameron doesn't do it. I'm not saying that Kelly doesn't do it. I'm just saying it's very clear that when he came on board onto the CBA, that wow, they all just had it was a breath of fresh air. Now maybe that's because Norris was more bash and grab sort of guy, and this one's a bit more cerebral. I don't know, but
and just for a point of reference, I went on Amber with the other banks. By the way. I think going forward they've got headwinds and they're very expensive. So there's no way I would buy the banks, any of them. Now, but of the banks, NAB is by far the worst.
Right.
Yeah, I agree.
Poor old NAB, bad of a bad bunch. That's all we have time for today. Thank you so much to my guests, Mark Morland from Team Invest and Matthew Kidman, investor, author, man about town. And to you, our viewers, and all the calls, thank you for that. The calls and the emails. Until next time, I'm Mark Todd from FIIG Securities. Have a great Friday night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for